The second form of financing is debt finance. We can also say that it is almost similar to taking a loan from the bank. It have its interest rate, it have its repayment schedule. So it is almost like a business loan that we take from banks. Let's try to understand it in a better manner. It have its own pros and cons. It is not always that loans are bad. Sometimes it is the right financing that you will be requiring for your venture. So let's try to understand why and when to go for it. Like bank loans, debt funding is the process in which an investor lends money to an entrepreneur for their business needs for a certain period of time at a given rate of interest. In exchange, the company sells the investor bonds that acts as a certificate for loan. Here, the startup has to pay back the debt fund on a pre-scheduled date along with the interest payment. In it, the investor's gain is obviously the interest payment, which is usually set at a very high rate in case of startups, just to compensate for the risk of business failure. Moreover, the business loan is provided against the company or startup's assets as debt securities. So in the case of non-repayment, business failure or bankruptcy of the startup, the investor or bank can recover money by seizing assets. Equity funding or VC funding, on the other hand, doesn't require the startup to pay back the money invested. It might seem like the right kind of funding for the first-time entrepreneurs, but there is one crucial clause that needs to be considered while making this pick. Equity funding requires startups to part with a huge chunk of equity, which the investors acquire against the funding they provide. This also gives them a place in board of directors, what we call board seats of the startup. And thus, with it comes the say in the business and day-to-day operations of startup. Since venture capital funding seeks earnings as big returns from the business, the investors attempt to ensure and secure that through dictating terms on the functioning and strategies of the company or the startup. This is where debt fund is far much better than equity funds. Here the investors only get the loan repaid with the interest and therefore has no right to interfere with your business. Thus, the founder can freely run their startup, their strategies, and their business the way they like it. So let us understand a bit about debt funding options for these startups. If startup choose debt financing as the mode of raising fund, it is extremely necessary for them to identify their needs and the fund requirements first and then approach the investors accordingly. Unlike venture capital financing, debt funding is not classified according to the stages of growth of the startup, but the nature of the needs and the tenure of the loan. Debt funding is thus classified as long-term and short-term loans depending on its uses and terms associated. The first one is long-term loans or the long-term debt fund. If the founder of the startup is looking to build infrastructure, set up equipment and bulk of raw material to start their business, usually these require a huge amount of money at different stages, and thus the startup requires a long-term fund. In this case, long-term loans are taken from the investor for arranging capitals in initial years and adding on capital in later years of business. These loans have tenure of at least more than 1 year and usually have a high rate of interest. Since these long-term debt funds usually have long tenure and are often raised at the initial phase of business, the investors see company assets as security or collateral and can also put forward certain terms and conditions known as covenants. Now let's see the short-term loans or short-term debt funds. Apart from capital cost, there are certain other expenditures that a company needs to take care of while running the business. Expenses like expense incurred on the salary of the employees, rents and maintenance fees, regular raw material requirements, etc. are termed as recurring payment, which at times too needs funding. For this, the startup seeks short-term loan or short-term debt fund, which is maximum of 1 year, and since these loans are of shorter period, the interest rate is comparatively lower than the long-term debt fund. Also with minimal or no collateral. Types of debt fund can be better explained through debt financing examples. Just think of a startup which provides furnitures and appliances on rent and operates through a mobile app. Anything like Rent O Mojo or Renticle. In this case, there will be various needs such as office setup, delivery arrangements, maintenance services, deployment of technology to run the app, maintaining the customer base, keeping track of their requirements, preferences and orders, and managing inventory and deliveries. Thus, long-term debt funds take care of all of these as well as working capital. But there are recurring payments as well, like rent for the office space, cost of management, and maintenance of inventories and wages of employee, the startup can raise short-term debt fund for these expenditures. As every coin have two sides, so is debt fund as well. So let's see pros and cons of debt funding. Knowing what debt funding is or what debt funds are, as well as debt financing, is not enough to decide whether to choose this route to raise funds. The startup must also know the pros and cons of debt funding and compare it with equity funding before they make their final choice. So let's start with the advantages first. So the first one and the most important benefit is that here the investors doesn't have the right over your company's decision. The startup gives the company bonds to raise money in this case, which is basically a certificate of lending and not a company share. So it's just a certificate of lending that you will be giving to the investors and not the company shares. Thus, the role of the investors starts and ends with just lending you the money and its repayment, and they have no rights to interfere in the functioning operations or business decisions of the startup. Thus, the founder gets to run their startup freely and retain autonomy over business decisions. Second, debt funding takes place for a stipulated period, thereby allowing the startup to enjoy the flow of money for the entire period. Compared to venture capital funding, this is surely an advantage, as venture capitalists can make an early exit and withdraw rest of the funding promised if they anticipate losses. Another benefit of debt funding is that the money raised at any time can be used according to the founders and business needs. Equity financing, on the other hand, is targeted to specific use cases, and the investors can intervene if the money is being used otherwise. The fourth one is a debt funding can be raised at any stage of the business, depending solely on the usage of the money and the time that will be required for the repayment. This is a benefit as well, as equity funding differs at different stages of the business. We all know about angel round, Series A, pre-Series A, Series B and all. So it differs in terms of the nature of investments, terms and conditions, and the investor's mindset and dealings. The next one is debt funding are provided at a fixed rate. So the next one is debt funds are provided at a fixed rate of interest. Compared to equity financing, this is profitable for entrepreneurs if the business earns return at a higher rate. On the other hand, in the case of equity financing, the investors have to be paid higher dividends in accordance with the profit made by the startup. Now let's see and understand the disadvantages of debt funds. The first and foremost disadvantage of debt funds is the compulsion of repayment irrespective of the company's condition. Unlike equity funding, here the startups need to pay back the money along with interest, irrespective of whether the business has incurred losses or earned profit. For startups that have a higher chances of failing, this is a major concern. Now let's see the second disadvantage. Startup debt financing is provided against the company or founder or promoter's assets, which are treated as debt securities. Thus, if the business fails or there is a bankruptcy, those assets can also be seized by the investor or the bank in case of non-repayment, leading to even higher losses. So it's not advisable to raise debt funds without adequate assets. And the third and the final disadvantage which we see is, since investing in startup is always a risky affair, startup debt financing is always provided at a higher interest rate. Compared to VC funding, it is always a disadvantage, as returns for equity funding vary according to the amount of profit. But with a fixed rate of interest that is high, losses will be more if the business doesn't perform well. So after the pros and cons, let's also try to understand a bit about the challenges which are faced by the startups in raising debt funds. As I always say, understanding the process of startup funding is incomplete unless one views it from an investor's perspective as well. When it comes to investing in startups, debt funding is of course the safest form for the investor. This is because while every business is volatile, startups are indeed the riskiest ventures. And here, debt funding involves repayment along with interest at a fixed rate. The success rate of startups are always being low. With the lack of money and inexperience of business strategies, there is no guarantee that all will fall into place and bring profits. Thus, returns from investment are not always secured. At this point, an assured repayment of the invested money along with the interest payment is indeed profitable. And even if there is failure into the business, debt fund investors can easily recover their money by seizing the assets of the founder, promoters or the company. Thus, debt financing can be called a stable investment when it comes to getting the money back. Moreover, if the company goes bankrupt, the debt fund investors are the first one to get money back, whereas venture capitalists are the last to get the money. It is for this concept of stability that even venture capitalist firms keep debt financing deals into their portfolios to balance profit and loss incurred. Despite that, finalizing a deal needs some sort of assessment by debt fund investors as well. Startup debt finances requires investor to do a proper background check and assessment of the business plan. This is needed to avoid hassles in future and maintain a good track record into debt financing. They also need to carefully assess the business plan to gauge its validity, probability of success, and strength of planned strategies. Now let's see how to raise debt funding. This is just a beginning when it comes to raise debt funding. Next, he or she has to do a proper market survey to make a list of investors and firms that are into startup debt financing and have a good experience and track record. Startups can turn to individual investors in the market who provide debt funds, as well as VCs that make startup debt financing deals to balance profit and loss in their investment portfolio. Banks, NBFCs, and MFIs also provide debt funding. To pick the right investor with a feasible rate of interest, the startup's founder need to do a thorough background check for their credibility and terms and conditions. The task that remains is persuading the investor, for which the entrepreneur needs to present a solid business plan, present a solid business pitch with the clarity of plans and strategies, company's balance sheet, and a defined path of growth supported by data and documents. Investors, on the other hand, go through all the documents and verify the startup's claim and credibility under the due diligence checks. So this is debt funding for startups. In the next video, we'll be talking about convertible notes and briefly a bit about safe notes as well. Thank you.